Okie dokie. Well, yesterday I sent everybody an email saying I noticed some things on some charts that we need to go over. And then today with the Coaches Roster newsletter, I said you're going to receive a little bit extra from me. And this is the start of that. What I want to go over is something that I noticed. I mean, as we all know, oil stocks have been just obliterated, something nasty. But I want to point out something very familiar and repetitive kind of throughout the sector. So I'm going to use this video as a means of doing that, and we're going to go over oil, gas, energy subsector preview, I guess you'd call it if you had to put a name on it. Starting out here with BP, British Petroleum. As you can see here on my weekly chart, it's a 5-year weekly, but we're actually approaching what essentially was like a double bottom support area from the lows of 2011 and 2012. Okay, you see this little hump with the two bottoms here. And what this line is this is marking my lowest weekly close. And you notice how close we are to that. That lowest weekly close value is 35.86. Now, after all of this falling, to come back to a point where essentially we double bottomed in the past, it kind of leaves me having to view that as a potential point where, this big drastic fall in oil could change, or at least the fall in the stocks could change. So when we look at these as kind of potential of what we could plan for interim level trades, I want you to look at what's actually happening and could happen with this stock. Now, I've got a few other lines on this chart. And as I've said in trading over and over and over again, trading is about trading between the lines. It's that easy. It's like a coloring book. Keep it between the lines. Well, as you can see from this support point, that 35.86 for the weekly close, if we were to hold and bounce here, the first topside area we would look at legitimately is a prior swing low point, and that's what I have marked right here at 41.44. And if we were to lose that line, we would look at our next support point, which, as you can see, is not very good if it were to lose that. Now, the reason I'm taking the extra time to do a video just on these oil and gas stocks is because they're at a point where just because they look like they could fall forever doesn't mean they necessarily will. As a matter of fact, we're quite close to a point where the falling could stop. But we're also quite close to the point where if it kept falling through it, it could get really bad, even worse than it has, or maybe even replicate the entire move it's already made again downwards, because as you can see, that'd be nearly a $10 drop. With this week coming up, I'm really going to be paying attention to these weekly swing points on these stocks, the oil and gas stocks, because I think that these could be stocks that give us some great opportunities. And plus, my largest long position is actually in ExxonMobil. So on BP, again, just to reiterate, you're looking for the support point at 35.86. If that fails, look to take something, 3, 4, maybe even 6 months out that would go in the money by 28, without seeing the actual option chain up during this video. I don't know what's available, but like a 30 put, a 27.50 put, 28 put, whatever. And if it were to hold at this point, something like a 40 call to get you up into this point, but give yourself, at least 3 months, give yourself at least out to like March to be able to do that. And again, with this, one thing I want to kind of point out, and I'm going to steal one from Sneeb's book, and he always says in the chat room when things come to this point, this would be a good strangle point. And if you're using a scaling in method for your trading, where, I talk about this all the time, where you take, a full position size and divide it by 3 to make entries in thirds, this actually would be a point where you would take a 1/3 entry in the puts, a 1/3 entry in the calls, and then wait for it to show you what it wants to do before buying the remaining third of the position into the side where it's moving towards. So that's something to kind of look at as a possibility, not just with this one, but with all of them. I can tell you right now, of all of the stocks, BP would not be the one that I would choose to go after, just because, I watch CVX a lot and I'm long in XOM, so I'd probably be more inclined to go towards one of those. Let's go over and look at Halliburton, HAL. Now, Halliburton had a much more drastic upswing, but I want you to look here after. Now, this was the swing point that I really thought it would hold a couple weeks ago. I didn't make a buy on it, but just studying the chart, I was like, you know what? I think that would probably be the point it would hold, and it didn't. It blasted through it so quick, it was ridiculous. The funny thing about this swing point isn't that it's a low point here, because you see it failed a low point there and low points here. It's actually that it's a W retest point. You see the W right here. It's a little lopsided, almost more like a cup and handle, but played really the same way as a W. So that swing point right there is actually here, which makes it a more probable bounce point. And it's right there again. So of all these stocks, we're starting to find that even though they've been, for lack of better vocabulary, beat to hell, they're actually at a point where, if they're not going to completely fall apart and just die into oblivion, then this is going to be the point where we could see them bounce. Going to move over to MPC. This is Marathon Petroleum. Marathon had done a stock split in the past. And you see with Marathon Petroleum, they're not specifically an oil stock. They haven't had the same fall. Last week was a bad week market-wide, so yeah, it had a bad week there. But you actually see on my Fibonacci extensions, based on the fact that it made a higher high here, using this high, this low, this high, it came back nearly to a retracement point. But what I want to point out about this one is, as bad as all of the oil stocks have been beaten up, eventually that's going to relay in other renewable energy sector stocks. And petroleum is one that lags oil. And if it lags oil, I want to look for a weekly close below 76.91. I know that's, $8 more bucks, $9 more bucks, actually $7 more bucks of a fall from the closing price Friday. But you see, that would be the point that would really open it up to, potential for a direct $12 move down. And then if it would just fail the first point that the oil stocks failed before they really started looking bad, you'd be looking at another $10 to $12 move down. And if the petroleum stocks just came right to where the oil stocks are right now, we'd be down at a point like this, around $44. So I'm not interested in playing like a bounce play on MPC. But if the oil stocks keep falling, if they fail these support points, knowing that they've already fallen so hard, and even if they could make lower lows sometime eventually, at some point they're going to get another relief bounce. Then a stock like MPC would be one to look at, because it hasn't started that big fall yet like the oil stocks. I'm going to go over now to a momentum trade. This was a big momentum stock throughout most of this year. I remember one of our members used to talk about this one in the chat room all the time, and I told him, get the heck out of your long, and look at it now, EMES. Big momentum name, a lot of people talked about. Well, I'm actually, I had to delete the line that I thought it would bounce at, which would have been 46.47. But I'm now looking to see if it can hold this little bottom, which was right before the momentum started taking. You see this thing was kind of just, nobody heard about it, and then all of a sudden, big momentum trade. Well, momentum trades, in a sense, are kind of like penny stock pump and dumps. Once that Momo is no-mo, a lot of time when those momentum trades that nobody had ever heard of before die off, they go back to the levels they were trading at before the momentum started. And then they'll just kind of continue trading in that way they were before. But see, the big difference with EMES now compared to where it was before the big momentum move is EMES now has solid fundamentals. Their earnings have been spectacular. And that's something that wasn't really seen before. Plus, at this price, seeing where it fell from, with a $1.38 quarterly dividend. I'm sorry, it's a 6-month dividend. No, I'm sorry, there you go. It is quarterly. With a $1.38 quarterly dividend, that's not too shabby, P-Man, if you're watching the video. So for EMES, if it can hold that $37, $38 range, this one might be one that if oil starts to rebound, you gravitate towards for commons, not even necessarily options. Because after the Momo is no mo, I don't always expect it just to, oh, well, look what it did before. It could go straight up there. No, I actually expect it to be a little bit slower again, like it was. Almost like you could put a big old X through all of this that's happened. It retraced completely. You can see it right there. It retraced the momentum trade completely. Basically Xing it out. And I would have more of an expectation of what it was doing before. So keep an eye on EMES if oil starts to rebound, because it could be a pretty solid longer-term portfolio stock. And remember, a lot of these stocks are falling not because of their fundamentals, simply because of the fears from the lower price per barrel of oil. Their numbers have been spectacular. Remember, just a few weeks ago, oil and gas stocks were reporting earnings, about a month and a half ago now, I guess. But oil had already been falling, and people say, oh, that's going to kill these oil and gas stocks. And it didn't. Their numbers were good. See, this type of stock is one that they're going to set their margins according to their production. And when oil prices slow, they're going to slow their procurement process and their drilling processes, which will actually flatline their margins regardless of the price of oil. So that's what I want to kind of be looking at. And another one, if you're not interested maybe in EMES and you want some with a better history, SLB, remember I talked about like the W points? Well, look at SLB. Not only has it come down to a swing low point, but look at the two different high points it had right here before it really broke out and start going. And if you trust Jim Cramer at all, he's said that, he just said last week on a show, 85 was a great area to buy again. But you have to know it might go down to 80, and then boom, where's it at? 80. And he used that number specifically, might go down to 80. It closed right at 80. A bounce here on SLB could be a spectacular entry point, and one that I actually think is a little bit higher quality stock than EMES. But I think EMES's dividend, which if it stays at this current price could be reduced, by the way, is still right now the one with the higher potential, because it did fall from 145. It at least showed you where it had the potential to go should the fundamentals stay the same. Going over now to APC. Now this is one that I've got to admit, I was quite surprised fell more from this point here. So this is one that I'm putting out there that is a little bit dissimilar to the other charts, but it could probably still be a very nice buy in that area around 66.50 or so. I think the chart would have been a lot healthier had it held up on this line there. But let's say, for instance, you maybe miss out on some of the other oil and gas stocks that hold out on these support points that I've been showing in this video, and they make a bounce and you're a little too scared yet to get in, and you see the move, and then APC's kind of trickling as the lagger in all of them. That might be where to go to. Now let's look at the three that I follow the most. COP first, ConocoPhillips. Very similar actually to APC's chart. Now here's what concerned me on ConocoPhillips. Do you guys see the weekly head and shoulders? Left shoulder here, the head up here, the right shoulder here, this line, you got it, that was the neckline, and we closed below it. ConocoPhillips is one that I've followed and traded quite immensely. Now I also want to look at one other thing. I'm just going to put my horizontal crosshair right here. do you guys see the ascending triangle that broke out from this point? See, we had this high here, came up, got close to it there, got close to it here, got close to it here, and then boom, broke out. All the while it was making higher lows. That's an ascending triangle. It failed the ascending triangle with the weekly candle close. That quite literally, if oil and gas kept being bad, could have us targeting all the way down here at $50.82 for ConocoPhillips. So if we get continued downside in the upcoming week, ConocoPhillips chart, simply based on this head and shoulders, the strongest, most bearish chart pattern there is, especially on a weekly chart. ConocoPhillips might be the one that's best poised, technically, to not just give us a good profit should it fall, but the one that gives us the best, most technical stop. At this point, if it were to close a weekly candle above that neckline at 64.97, the trade would be over for the head and shoulders trade. So if it continued to push downwards, this might be the one that is technically, based on how chart patterns work, giving you the safest stop for a short. Let's go over to CVX. What's funny here is this trend line right here. Let me actually back this chart up to a 10-year. Just go with the 10-year weekly. And you're going to see that that's from the March 2009 lows. And then here. And hey, I'm going to go back to the 5-year just to make it so you can see the chart a little better. It closed right at it. Quite literally, it's bounce or bust time for CVX. Because I wouldn't be surprised, even though I doubt it would just be one big red candle. I think it'd be kind of like this. You see where it fell, did a dead cat bounce. It fell some more. Eventually, there's going to be another dead cat bounce in there. We just talked about this in a lot of our charting and in our videos that we've done. This last week's webinar, we actually used this weekly chart on CVX as that example of the dead cat bounces and how consistent they are. But even through the process of dead cat bounces, if it gives up this trend line, I think someday, somehow, even though it's still a rising trend line, it will match up with this trend line down here, which is from a 20-year chart. And I think by the time it did, it might be around $85.88. So that would have to just kind of go to the point where those meet, and that's roughly where I think you'd be around. So be very careful, but you can also be watching CVX here. If CVX makes this fall, I don't think it's the best one to go in that gives you the best technical stop. Remember, I'm not one to say just make up a random stop point anywhere. That's bad for your trading, because then if you actually stick to it, you get stopped out. And if it made no sense, you might get stopped out and then it still continue in your direction. COP with that head and shoulders on the weekly has the best technical stop point. CVX trades very, very similar to COP. Use this chart in that breakdown of that long-term trend line to help you establish the power or the success rate of a potential puts player or short in COP. Now let's go over to XOM, because not only am I long in this one, but I know a lot of other people are too. But luckily you guys have Coach Mike, and Coach Mike told you to buy puts. But our puts expire this coming week. They're the December monthlies, the December 20th expiration. Now, just like most of those other charts, you're going to say, hey, we're kind of in that area of a long-term support point. So I want to express to you what my plan is for my puts. You see this bottom of these lines right here, which is at the value 85.10. If by the end of the week we're still holding that 85.10, or maybe if we dip down to it and actually make a positive move off of it before Friday comes, the expiration day for our options, I'm actually going to look at that point to sell my contracts, not exercise them, and use the profit from them to buy more shares. And then if it fails that line, I'll buy puts on all of that. If it does fail this line while I'm still in the puts, I'm going to look at rolling them over to January 17th of January monthlies. If it's still falling and falling hard by Friday, I want to roll it over into another puts play. I'll make sure to alert it too if I do it. But I'll be looking at those January monthlies if it continues. So right here, just like all these other oil and gas stocks I've talked about, they're right at points where it is possible that they bounce. As bad as they look, it's possible that they bounce. And if they bounce, well, hey, we're up huge in those puts that we got, even though they're just there to protect our commons. So we'll need to be aware of that potential bounce point. Know that, hey, this is a point where, man, if it's going to bounce, it's going to do it here, because if it fails here, this thing's going to be really ugly. Borderline uninvestable. More like, oh crap, now we just got to wait forever for this to drop and then eventually make a higher low before we actually invest in it again. That's the glory of those puts against our commons. It allows us to ride it out time-wise, and that's what we need to do, because remember, this position is for those out there that are building their portfolio, and you can't build a portfolio by tucking your tail and running at the first sign of danger. ExxonMobil's not going anywhere, and if it does, we have puts to protect it. So I wanted to make this video and kind of review these oil and gas stocks, because I do think that they are where we need to be looking this week for some potential swings. Now there's some others that I'll be putting out on another video to follow this one. But honestly, this video right here is probably second to the market overview video this week in the level of importance it has to you. I'll see you in the chat room tomorrow.